Thanks for joining us on Powerlines. This is Bloomberg Quint. I'm Harsha Subramaniam.
Good afternoon. I'm Meera Dugal. Let's get you the headlines. Indian markets break a two-day losing streak. The Nifty hovers around the 11,300 mark, led by a rally in metal stocks. The mid-cap index underperforms.
The market regulator approves changes to FPI ownership norms, also allows for a wider purview of the consent mechanism and cuts expenses paid by mutual fund investors.
The Aditya Birla Group is open to new acquisitions abroad, provided it fits in with their core businesses, says Group Chairman Kumar Mangalam Birla.
Banks are unwilling to lend to road developers, says Union Minister for Road Transport and Highways Nitin Gadkari, urges lenders to support individual players. But first, let's take a quick check on how the markets are faring today. Yatin is here with the key movers this afternoon.
Well, the market, is almost flat in trade, and if you look at the Nifty advanced decline ratio, despite the markets being like 10%, 10 points up, we have the advanced decline ratio almost, 3 stocks advancing to 2 stocks declining. But the overall broader market has seen some good amount of correction. But talking about the gainers first, we have Coal India, ONGC, BPCL, GAIL. So the top 4 gainers are, all of them are PSUs gaining anywhere between 2 to 2.5%. So the overall PSU pack is looking decent in trade today. Apart from that, on the losing side, we have Z, which is, corrected sharply, almost 3% down on that one, with almost 15 lakh shares traded in the cash market on the National Stock Exchange. The Bajaj Finance, the Bajaj twins, Bajaj Finance and Bajaj Finserv, both of them are down 2%, and recently we have seen both of these stock correct over 10% from the recent peak, so good amount of correction coming in that. Titan also down 1.5%. We have brokerage firm CLSA, which had downgraded the stock today from outperform to a sell rating. Target price has been cut sharply to a level of almost 720 rupees there. Anil Ambani, group stock. So the ADAG pack has been witnessing some sharp correction. So we have the likes of Reliance Infrastructure, Reliance Communications, Reliance Capital, Reliance, Asset Management, all of them down. And also, apart from RNM correcting in trade, we have HDFC, AMC also correcting sharply after we have the market regulator SEBI, slashing those fees for asset management companies, which have a significant impact on their earnings. So the asset management company, most of them are down sharply in trade, almost 8% down for HDFC AMC today.
All right, Yatin, thanks for that. Let's move on to the currency. The rupee came back towards 73 to the dollar in trade yesterday, closed at 72.97. A little bit of relief this morning, but still trading at 72.75. This is after just 2 days that the government announced some measures to try and support the rupee. Clearly, they've done little. Now, some people are saying that interest rate hikes are required to support the currency, also to address some of the current account deficit concerns that have emerged. Among them is Jahangir Aziz, head of emerging market economics at JP Morgan. He's joining us here from the sidelines of the JP Morgan conference. Jahangir, thanks for joining us. You've been saying that the interest rate defense is required at this stage, given what's happening on the current account deficit and the exchange rate. I'm keen to understand why and how you think it'll work.
Well, almost everyone will agree that there are two different reasons as to why the pressures on the rupee are building up. One of them, of course, is domestic, that we have a rising current account deficit, and the other is external, that we've seen a global financial conditions tighten, and that in the month of August got translated into a reassessment of emerging market risk. I think where we differ is in the first part, which is what are the drivers of current account deficit. And I think the way we are looking at it is that, look, if you get into exports and imports and exchange rates and oil prices, you'll get completely lost in the weeds. There's another way of looking at the current account deficit, which is basically it's a part of investment that is not financed by domestic savings. That's the amount that we go abroad to borrow, which becomes the current account deficit. And so the question is, what is happening that has made the current account deficit wide? In our view, 2 things have happened. One, in the first 2 quarters of this year, we have seen some increase in investment. But at the same time, our sense is that both household and corporate savings have fallen, and government savings, which is basically the overall fiscal deficit, hasn't really moved very much. Consequently, that increase in investment is being funded abroad. So the question is, what do you do to bring down the current account deficit, A? And B, what do you do if the reason as to why there are these concerns is global financial conditions tighten? And I think you need to respond to both. And we're not saying that interest rate is the only tool. We are saying that if you have only one valve of adjustment, which is exchange rate, then we do know that that adjustment will be outsized, and which is exactly what's happening. So the adjustment needs to be spread across both interest rates and reduction in fiscal deficit. So I think we're not saying that that's the solution to everything, but that has to be part of the problem, and it's much better to distribute the adjustment across different areas such as fiscal policy, monetary policy, rather than let exchange rate be the only valve of adjustment, because then the adjustment will be very, very large as it's happening.
So you're not a believer, Jahangir, of the view that let the exchange rate adjust to a level where automatic stabilizers, etc., kick in, and that would be enough to balance out, at least on the consumption side, some of the issues about excessive imports on the non-core areas, etc.
This idea that at some point in time, Indian assets valuation will be sufficiently cheap because of the FX, and that will be the incentive for capital flows to come back into India. That could well be true. And if we go down that route, that we only allow one variable, and which is what I'm trying to repeat, that if we allow only one variable, which is FX, which is the only way in which valuations are adjusted, then that adjustment necessarily has to be large. My point is that there is another way, a much easier way of doing this, which will keep the adjustment on the exchange rate modest, or will contain the adjustment, which is a fiscal policy and monetary policy comes and plays a helping hand in the adjustment. If you don't do that, then yes, at some point in time, valuations of Indian assets will be cheap enough. But if exchange rate is the only way, or reducing valuation is the only way in which we are going to adjust to this, to the stress, then I think we might have a very long way to go.
So the other complication is with the use of interest rates in this current flexible inflation targeting regime. Inflation is seen about 4.5% at the end of the year. It's been underperforming expectations last couple of months. How does the MPC actually justify higher rates at this point in time? Isn't that a tough one?
Not really. I mean, there are many inflation targeting economies in the world. India is not the only one. If you look at inflation targeting economies in the world, they have been around for about 20 years. All of them face the same problem, which is that they have certain domestic variables, let's say in this case inflation and whatever goes into inflation, and because they're open economies, they also have external variables such as global financial conditions, US interest rates, etc., as part of the inflation targeting framework. The problem is that India's inflation targeting framework is based on this antiquated belief that India is a closed economy, and therefore, within the inflation targeting framework, there is no reference to global financial conditions. What we have seen over the last 10 years, repeatedly, 2008, during the Lehman crisis, 2011, the European sovereign debt crisis, 2013, the taper tantrum, now that India is not an open economy. Now, I go to any inflation targeting open economy central bank, they do respond to, obviously, to domestic variables, inflation, growth, slack in the economy, inflation expectations, the whole host of them, and separately and explicitly, they also react to global financial conditions. And I think that's the problem, that because we think that we are an open economy, we are a closed economy, but in reality we are not, is this inconsistency that we get, that when we do inflation targeting, we think, well, you really cannot respond to global financial conditions until and unless domestic variables change. And I think that redesigning has to be done, but I don't think that there is absolutely any inconsistency between looking at inflation domestically and responding with interest rate to global financial conditions.
All right, Jahangir, on the import-export side, the other thing that's being considered is some sort of import curbs or higher duties on imports. What do you think of that? Do you think something like that will work, and is it even advisable?
Look, let me get back to the way we look at current account deficit. We are we are looking at current account deficit as a lack of savings in the face of rising investment. That the saving investment imbalance has gone against India, and that's being reflected in the higher current account deficit. We don't think it's an export-import problem. So, those measures that the government or other analysts, et cetera, are suggesting, those to us are actually barking up the wrong problem. The problem is insufficient savings. The problem isn't that there is, whatever, non-essential imports are rising. I mean, I don't even know what non-essential imports are, right? I mean, so yes, I'm somewhat uncomfortable because we don't see it that way. I think it's the wrong description of the problem, and if that's the wrong description of the problem, then these prescriptions that are being provided for that problem, I'm somewhat uncomfortable with them. I think the real problem is insufficient savings, and that needs to be addressed.
All right. There's also in the interim, short-term fixes being discussed. Jahangir, NRI bonds, FCNR kind of deposit schemes that were used in 2013. The problem there again is that if you keep going back to these so often, they're no longer one-time fixes.
That's correct. In the following sense, that the description that we are now that's floating around, right, among analysts and policymakers and market, etc., that magically in 2013 all of India's problems went away because they did this NRI deposit. If you look at what happened in 2013-14, it started out with a 300 basis points of rate hike. It was followed by a very, very large fiscal tightening that was squeezed into a pre-election year in the last 6 months. Only after that did the Indian government go to with the NRI deposit. And remember, the NRI deposit did not come without a cost. There was a massive subsidy provided to Indian commercial banks in order to make it lucrative for the Indian commercial banks to actually go and get the NRI deposit. So the idea that even NRI deposit in 2013 was the magic solution is actually incorrect factually. And if you go to the foreign markets and you say, look, I want $10 billion of bonds, or I want X billion dollars of non-resident deposits, or whatever you're looking for, but I'm really not going to move on my monetary policy. I'm really not going to move on my fiscal policy, and so that money is essentially a substitute for not moving on policy. I really don't think you're going to get very many takers.
All right, Jahangir, last question. On the global front, what are the upside and downside risks to the environment as you see them?
Right. So I would say that, clearly the biggest risk right now is how the trade war, or the trade tensions, let's not call it a trade war, trade tensions proceed in the next 3-4 months. We are focusing only on one side of it, which is obviously should be the case because it's close to our neighborhood, on the US-China trade tensions. But remember, there is also the Section 232 auto tariffs that are being studied, which is going to be global. Let's add to that we still do not have a resolution of the NAFTA 2.0. So my sense is that, unless all of these things get to some form of resolution, I think the heightened uncertainty is going to keep dampening business sentiment, and with that, I think both in emerging market as well as in developed market, that's going to have a dampening effect on investment, and I think that's the biggest risk. I think more immediate risk would be that I don't think any of the current account deficit countries, maybe Argentina, maybe a little bit Turkey, has really reacted so far to the tightening in global financial conditions and to the reassessment of EM risk. I think all of these current account deficit countries will have to follow up with much tighter fiscal, much tighter monetary policy, and that will necessarily have a dampening effect on their growth prospects. Maybe not in the third quarter of this year, but definitely in the fourth quarter of this year and in the first quarter of next year. So I think there are these near-term concerns. One, of course, is the global concern on trade, but I think as far as the current account deficit countries are concerned, it is a reaction to the policy tightening that is likely to come and the impact that is going to have on growth in the coming 2 quarters.
All right, Jahangir, thanks so much for that.
Let's move on now. The SEBI board has a lot on its plate on Tuesday. The market regulator had decided to accept most of the recommendations made by the individual committees appointed to look into issues like FPI ownership, the consent mechanism, and lower total expense ratio, or the TERs, for mutual funds. Sarjeet is here to take us through some of those big decisions that were taken by SEBI. Sarjeet.
That's right. If you look at SEBI's board meeting on Tuesday, the board has nearly accepted 4 committee recommendations, and that are major recommendations with respect to FPI. FPI was the HR Khan panel. The regulator did not spell out exactly what the recommendations they have approved, but they said most of the HR Khan committee recommendations has been accepted, and the fact that even though now they are not going to block NRIs or NRI residents to come into India, they will still have to give the beneficial ownership of the funds which is there. So that's one which has come. The other big thing is about the listing. It has come down from T+6 to T+3. So that's faster listing for companies, because earlier it used to be at one point in time it used to be 14 days, down it brought down to 12, then 6, now to 3. That's that has been done. They've expanded the definition of for consent applications. This is based on the Justice Dave committee, where they are talking about how some of the fraud cases can be consented, but these are small ticket frauds, because they're saying that they have thousands of such cases where they are involved in it, and because of the current regulation, which FUTP is not part of it, they are not able to consent and do away with those. So they have gone with the committee recommendations. Unless these frauds are have a larger impact on the market, they will go ahead and consent. That's what the chairman said. Insider trading, there is some bit of insider trading, who are part of insiders, and what kind of legitimate information can be shared. That's one thing which has come in from there. The other thing was amendment to the delisting regulations. Where voluntary offers can be countered by promoters with a counter offer for price. Currently, voluntary delisting is something which is done through a reverse book building process, and sometimes we see that the prices go up very high. So that could be countered by now by promoters who can give a counter price for voluntary delisting, which is one of the case here. So these are the big ticket things which are happening, but as I said, everything will depend upon what exactly is the details of the circulars when it comes out. We just have been given the brief outline of what the releases are.
Very quickly on the total expense ratio.
Well, that's something which is going to hit the industry very hard. Broadly, I'll give you an indication that the total industry revenue is around 13,000 to 14,000 crores. What the regulator has done is that it's reduced interest and based it to the average AUM of all the schemes. Now, as a result of which, the impact on the industry will be between 1,300 to 1,500 crores. And we've seen the impact on 2 of the stocks, which is SGFC AMC and the Reliance Nippon AMC already, which are factoring in the impact, because that goes directly to the bottom line of all of the AMCs. What the regulator has also done is that they have removed upfront margins and the trail commissions. Now everything earlier it was given by the AMC, now it's going to be deducted from the schemes, which basically means that there is going to be a disruption in the entire distribution channel of mutual funds. Regulator has been pushing that distributors should select whether they want to distribute mutual funds or advise on mutual funds, and this is something both can't be clubbed, and this has been going for last 2 or 3 years as of now. So now I think they will move towards that, where distributors will have to select one of the two, whether they want to advise or because distribution fees are going to come down as we go forward, and it's not going to be very lucrative to be a distributor. So advisory is something which the regulator want a distribution community to move towards and start asking the user or the customer for the fees of advisory rather than mutual funds subsidizing them for the advisory.
All right, Sajid, thanks for setting that up. Actually, Jayesh Khilnani is standing by with a deeper analysis of the impact of these changes on fund houses, schemes, investors. Jayesh, take it away.
Ira, just before that, I want to extend Sajid's point. Why the distribution fee is actually going to come down is because I've spoken to a lot of asset management companies, and they have clearly said that this cost will now be, borne by the distributor himself. So that's the reason we are going to see a cut in the distribution fee. The AMC largely will not bear the brunt of it, or major portion will actually go to the distributor. But if we have a look at the categories that they have defined and what are the new expense ratios and what is it currently at, who's going to get impacted, that's how the picture looks like. So 0 to 500 crores, it's 2.25%, while the average so far, as per data collected from the Bloomberg, shows that it's 2.4%. So no major hit coming in as far as schemes which have AUM from about 0 to 2,200 crores. But if you have a look at the larger schemes, which is the 2,000 crore to 5,000 crore scheme, those will get more impacted, so on and so forth. Over there, the basis points is as high as 50 to 60 basis points. So that is significant, as compared to the industry, what they are actually currently charging. So they will have to reduce their expenses. On the other hand, this actually becomes more lucrative for the investor to invest in larger schemes. But if we have a look at some of the other data points that we have collected, if we can go on to those, you'll see that what this will actually do is, first of all, create a level playing field. Going forward, there would be no distinction between a larger and a smaller AMC. Of course, there will be revenue reduction, but to my understanding, it is going to be passed on to the distributor. And of course, Sajid spoke about the upfronting of the fees as well. Now, if you look at some of the top schemes where the expense ratio is on the higher side, we've culled out the top schemes in each of those categories. If you have a look at the 0 to 500 crore AUM, a couple of funds from the SL group stand out. So currently they are expected to charge about 2.25%, wherein all of these three schemes are in excess of 3%. Total expense ratio. But mind you that this ratio in each of the slides will look a little higher optically. That is because they have already gone at 20 basis points or a 0.2% reduction in the expense ratio recently in the last couple of months, and on account of GST implementation as well. So going forward, FY19, this will automatically come down, so the differential will not be as high. The other point that really stands out in all of these plates is that there are few funds from the same house, which is SBI and Aditya Birla. So these actually figure out, appear in most of these categories. So even for the 5,000 to 10,000 crore AUM, the SBI Magnum Multicap Fund is there, as is the SBI Magnum Tax Gain Fund. So you have some of these names, so interesting names from the SBI and Aditya Birla Fund House that you have on these, changes.
All right, thanks so much for that, Jayesh. Let's move on. An inter-ministerial government committee has recommended the setting up of an independent payments regulator. Now, this is not the first time this has been suggested, but the fact that government-led committees are continuing to push for it probably sets us up for an interesting battle between the Reserve Bank of India and those who want the payments part of it taken out of the RBI's purview, at least directly. Vishwanath Nair joining us with the details of what that committee has said. Vishwanath.
So this committee included members from UIDAI, the Department of Legal Affairs, as well as MeitY, apart from, of course, the Reserve Bank and the Finance Ministry. According to what they've said in their recommendations, the payment system regulator they call it the Payments Regulatory Board, that needs to be outside the purview of the Reserve Bank of India. In their recommendations, while these deliberations were going on, the Reserve Bank had said that there are countries where the ambit of payments regulations remains with the central bank, and therefore the RBI should be allowed to do that. But in the committee said that countries like UK as well as Australia have had a separation of duties. So it is essential that the Reserve Bank of India does not remain in control of the payments regulator, but that there is some kind of a coordinated effort by this new regulator as well as the RBI to ensure that payment systems do not end up affecting the broader banking system. They, as part of the regulations, as part of the recommendations, they've also suggested that the chairman of this regulatory board be a member that is selected by the government in consultation with the Reserve Bank. Remember that the Reserve Bank had originally suggested that the RBI governor remains the chairman of this committee, and thereby they have some kind of vote in whatever the payments regulator does. So these are primarily what the RBI had suggested and what the group eventually decided. The group also looked at some of the recommendations by DFS, where the DFS had suggested that the government should hold about 51% equity in NPCI because it is a large payments body. It is also a player while acting as somewhat of a regulator, so the government should have control over it. But the group said that this probably does not bode well, and it's not advisable that the government enter the ownership of a payment system. So that they've taken out of the debate. So, broadly, these are the major recommendations. They've also made some amendments to the current payment systems law, so as to make all of these to ensure that the regulator comes on board. But of course, we're still going through the document, and a major part of the settlements is just this.
All right, Vishnu, thanks so much for that.
Here's an unlikely or rather unexpected fallout of the what's going on with IL&FS. IL&FS's junk rating has repercussions abroad as well. Dim sum bonds issued by one of the subsidiaries of IL&FS has slumped by 69% this year. This is the sharpest, of course. Let's bring the chart up. This has been, obviously there's been a rating cut to below investment grade. This is the 7.5% 2021 securities sold by one of the units, as I mentioned, of IL&FS. This is slumped 69 points, I beg your pardon, to a record of 31.3. These are yuan-denominated bonds which have been sold by one of the units of IL&FS to global fund managers.
Aditya Birla Group Chairman Kumar Mangalam Birla is hungry for more deals and is looking to create the country's largest telecom company, along with bidding for assets under the IBC. The conglomerate is now looking for assets in the US, Europe and India. Speaking to Bloomberg's Haslinda Amin on the sidelines of Bloomberg's India Economic Forum last night, he talked about what kind of assets he may be looking at.
We announced an acquisition of an American company headquartered in Cleveland called Alaris, again in the space of aluminum rolling. That actually bolsters our position in that space even further as the global leader. That requires CFIUS permission because they actually supply to the aero industry. So from a defense point of view, they require CFIUS permission, which goes right up to the president, I believe. I don't think that this would work against us. I think that we're very confident from whatever we've heard from consultants there, from people at CFIUS, that he or the dispensation should be positively inclined towards an Indian company making an acquisition of this kind. So I feel very sort of positive about it. I don't think that there should be any negative impact on account of that.
Are you looking at more M&As overseas, and what's looking attractive? I mean, the US could be attractive right now.
So our M&A activity has been very specifically focused around business rationale. So either you're getting into a new market, or you're backward integrating or integrating forward into value-added products. And the basic question for us for an M&A, for making an acquisition, for example, is will this add value? Given the fact that we are a global player, more than half of our revenues today come from overseas, we're very comfortable operating anywhere in the world. And
You're looking for M&As right now?
We're constantly looking for M&As. We're constantly looking for M&As.
In the US, in Europe?
Both in the US, in Europe. as also in the country here in India. And I think that if you have an opportunity which we believe is value accretive, fits in with our overall strategic architecture, we would be very comfortable and happy to look at an opportunity. We've made 35 acquisitions in the last 2 decades. So I think integrating acquisitions into the company is something that our teams have learned to do pretty well.
And I know that you have more than a 90% success rate in terms of consolidating. I'm just wondering whether you would venture outside of the sectors that you're already in. Might you do that for growth?
So that's unlikely. I think that what we have done always is follow the philosophy of growing in overseas markets or foraying into overseas markets for the first time in sectors that we are familiar with and that we are present in already. I think it's unlikely that as a philosophy we would go into a foreign market with a business that we don't know anything about and that's completely new to us.
Kumar, Mangalam, Birla at the Bloomberg India Economic Forum last evening. Road and Transport and Highways Minister Nitin Gadkari can't get bankers to lend for road projects. Risk-averse bankers are slowing down infrastructure projects in India. He said that at the India Economic Forum last evening. In a conversation with Unikrishnan from Bloomberg News, he called for support from bankers for the sake of the economy.
1 month before, the State Bank chairman gave me 25,000 crore check. And he was telling many bankers contacting me, they are offering me the money for that. You go APC mode, we are ready to finance you. But it will be difficult for us to finance contractor. This is a problem. Now the bankers are not giving the bank guarantee. Now for the sake of industry, sake of investment, sake of contractor, creating jobs, sake of economy, we need that. We are expecting positive support from the bankers. Now they are giving support, but there is a slow process is going on. I have a meeting with the bank chairman and MDs. I request them. They are supporting. I am confident that in due course of time, the situation will be changed. But we are expecting more cooperation. Our total sector is very secure. I am giving you the example. When I had taken charge as a minister, there was toll project 403. Involvement of cost of 3,85,000 crore. We have already solved 99% problems. We have taken 22 cabinet decisions by the blessing of Finance Minister and Prime Minister, by which we resolve the issues now. So we save the Indian banks from NP of 3 lakh crores. My ministry has, because of that, the Indian bankers are benefited. Now I am requesting them, there is no risk as far as the road infrastructure project financing. There is no problem. I am going to create more positive confidence in the mind of the bankers. And I am expecting that if they should cooperate, it will be nothing like that. Otherwise, NHI and we don't have money problem. I can raise the money from the market, going with the EPC mode. I will construct the road, and by TOT method, I will make it for foreign investment. I will get my money back. So this is the proven track for me. But in the interest of economy, I am more interested about the investment from the stakeholders, from the contractors, foreign investment. And that is the reason that we need some positive support from the banks. And I am assuring them that don't bother now. 80% land acquisition, we are not giving appointment date. Environment forest clearance, we are not giving appointment date. Utility shifting will be our responsibility. Our 40% hybrid annuity model is very successful. We have already awarded the projects more than 1,50,000 crores in the hybrid annuity mode. So my feeling is now it is to be bankers to be very positive, and we are expecting support from them.
Meanwhile, SBI's Managing Director Arijit Basu explained why lenders are still cautious about lending to infrastructure players. Speaking at a bankers panel soon after Nitin Gadkari had delivered his address, Basu said that banks which have borne the brunt of bad loans don't want to venture into lending to mid-corporates with high-risk exposure without actually mitigating that risk.
I think there is a slight dichotomy that we also face as bankers here. The best rated corporates are the ones to whom we would like to lend, and especially in this situation. They have always a AAA rated borrower or a AA rated borrower, other than most of them have access to all the markets which are open in India, whether it's a bond market, CP market, the capital market, and they are normally credit light. the need for borrowing is less. The need arises from either the MSMEs, to whom, of course, as public sector banks, we are all committed, and we have also done a lot of innovations on the digital platform and on platform-based lending, as we call it. I think all the banks are doing, and things should look up. But it is the mid-corporate sector which actually, barring the very large corporates, which also finally toppled over primarily in infrastructure finance, it is the mid-corporate sector which entails the maximum amount of risk-taking for us. In that, we need to proceed cautiously. So I think the current view that we have in our bank is, look at it sector-wise, look at the intrinsic strength of the company. So there are certain sectors, as we know, which has already started reviving, like steel and cement. That is reflected in the NCLT realizations also. That is also reflected in the health of the corporate. So what my expectation would be, that corporate growth would not be as much as it was, say, 2 or 3 years back. It would be relatively more muted. But unless and until we have a reasonable growth, between, currently it's 4 to 5%, it should go up a little more. But again, I don't think any bank will do that unless they are able to mitigate the risk which arises from this kind of lending.
Arijit Basu from State Bank of India. Out of time on the show. Thank you so much for joining us.
Lots more coming up on Bloomberg Quint. Stay tuned.